Hello and welcome, my dear friends. I present you 3 dividend stocks from the United States with an extraordinary high dividend right now. And I tell you if, in my point of view, dividends are safe and if the stock is undervalued, so that you can maybe, hopefully, get more capital gains or additional capital gains as well to extraordinarily high dividends. My name is Thorsten. I am the founder of Dividend Stocks Cash. We have more than 110,000 registered members. It's all about long-term dividend growth and sustainable capital gains. So, how did I proceed to find stocks with extraordinary high dividends? I asked the Dividend Turbo here. Then the Dividend Turbo is a nice tool. First, I was going to say I'm just interested in the United States. I set the filter, and then I was sorting in descending order this column, and this column shows us the stocks whose dividend yield right now is above the average within the last average dividend yield of the last 12 months. So let's go. And then you see it here, for example, PetMax Express dividend yield of 30.35%. Always looking back from today, what's dividend yield calculated by the last 12 months, by the dividends paid within the last 12 months. And here you see, for example, PetMax Express 30.4% dividend yield, and which is 5.5% more than in the average of the last 12 months. But if you look here, for PetMed Express dividend history, we have the estimates, and it's no dividend at all very soon. So they have not only dividend cuts, but they skip dividend altogether. So there are here many false flags if you look like this, because very often extraordinary high dividends call them a dividend trap. They are not sustainable. But if we scroll down for more and more, then we see more and more real opportunities of companies whose dividend is really extraordinary high. I just clicked on FMC Corporation, for example, and here you see the dividend got a boost up to 4.2%, and there's no dividend cut here, according to analysts. Okay, I selected like this 3 stocks, and I am now going to our screener because I already know which stocks I selected, of course. And the first one is a company called Pfizer. Pfizer with a dividend yield of 5.8%. Everybody knows, at least since COVID, what Pfizer does. So I skipped the subject. And if we look in the Dividend Turbo, you see now enlarged that the dividend yield is much higher than in the past. And we can look also at the performance here within the last 10 years. Performance was up 42%, but not capital gains. Everything came from dividends. Here you see dividends, $30.76 for one stock accumulated over 10 years, and the stock price lost $1.30. You see it here to there. Stock price was down slightly, and the blue area chart indicates the dividend on top of the capital gains or capital losses. You can also see here the performance since the beginning of 2000. Okay, lackluster performance right now. The stock price dropped considerably, more than 50% from all-time high. Pfizer lost already. So, question is, are dividends safe? Let's find out. Then the quality check, and then we see here earnings per share, free cash flow per share, and the dividends. We also have adjusted earnings here, which are a little bit higher. And we see that here we have some problems. Okay, let's go first to margins and revenues. Here you see that revenues really went up during Corona 21, 22, It was the time when Pfizer made around 37 billion US dollar revenue just with vaccination. It was codenamed Comirnaty, and this was nearly half the revenue in 21 was done with this COVID vaccination. And now the running business here, which is already closed, but we don't know the exact numbers yet. It's estimated that it will make around 11 billion still, and one more year, and then it's estimated that with COVID vaccination it will do less than 6 billion. And this, of course, cannot be compensated, this considerable loss. What's even more, in my point of view, what's even more troublesome are the margins. We have here a drop in operating margins, considerable drop margins with 50.4% on all-time low here. And furthermore, they are not important in the boom market obesity, where Novo Nordisk and Eli Lilly shine. And diabetes, they also have headwinds. There are medications which are in the pipeline, but they had some side effects, unexpected side effects, and that was so as I say, they have some problems. They have a big portfolio, but it seems right now that they have no blockbuster, no future blockbuster. So we need to think about that when we do the valuation of the stock. And here you see that according to analyst estimate for the whole business year 23, dividends are even not covered, not by the earnings, reported earnings, and not by the free cash flow, which makes it even more important to look at the balance sheet if dividends can be financed by balance sheet. And here we see, okay, we have already right now for the last 4 quarters uncovered dividends. Dividends 9.2 million, free cash flow 8.2 million only. So we have 1 billion under coverage, but we have liquidity of 44 billion US dollar. So Pfizer can continue paying dividends even if the running business, if they're not financed by the running business. So I think right now I don't see dividend cut. But we need growing margins again, at least for dividends to be sustainable. So there is a little question mark regarding Pfizer. If you can live with that little question mark, and maybe you say, okay, I still could buy the stock, it all depends on its current valuation. Then I show you the multiples of Pfizer, and right now multiples are on the historic average, which is not so good maybe because they have problems right now. But then you must also consider that here the price earnings were really low and lower than the average, and they were really low while the business boomed. Normally it's vice versa. When the business boom valuation, the stock gets more expensive with higher multiples. This time it was different. It was different because the market knew in advance that here this boost in earnings will be gone after COVID-19 will be gone. So what happened was that if we add the fair value here based on adjusted earnings, you will see that with on an average of 12.6 multiple, the fair value was as high as 83 US dollar, but the stock price was only about 50 US dollar because the stock market knew that earnings will go down relatively fast after the corona surge. Okay, this is exactly what happened. Current stock price is 28 US dollar. Let's zoom in a little. And then you have an expected yield of 11.5% if you just take out of the box the fair value calculation with an average multiple of 12.6. Now, in my point of view, I would like to make a risk adjustment because the pipeline of Pfizer is a little bit troublesome, and I would make 12, only 12 average, and then we have a new expected yield coming from capital gains, which is much lower. And here's the annual yield, 6.3%. And this already indicates my skepticism about Pfizer, and 6.3% with a risk adjustment I would like to make as a prerequisite to invest into this stock, and then I have a result of 6.3% annual yield with all the risks I don't like. So honestly, and I selected Pfizer because it's a very well-known company, and this high dividend yield of more than 5% really shines. And I think many people or investors are looking into Pfizer and asking themselves, should I maybe buy the stock? My opinion, no, I would not. Okay. You might think differently, then please drop a comment below. Okay, next company is Wendy's company, fast food, same business as international brands or McDonald's. And they have a dividend yield currently of also more than 5%, 5.2%, and should increase in the near term. Forget the dividend increase here, it's too much in the future. And there's only one analyst estimating this. So it's more of the mathematical reason why dividends go down, because there's only one analyst. Here are 3, 4, 5, 6, 7, 8, don't know how many. And this is just a pessimist who remained. Dividends very high. And if you look at the performance, you see here performance of 154%, better than Pfizer, considerably better than Pfizer, because here we have capital gains as well. And let's check if dividends are covered and safe. And I want to zoom in here. We take the adjusted earnings, free cash flow, and then you see, okay, adjusted earnings perspective, but also reported earnings. They don't cover dividends 100%, but free cash flow covers dividends 100%. So here it's also important to look at the balance sheet. And we do this right now. And then we see that according to the free cash flow, we still have covered dividends. Dividends 185 million US dollar last 4 quarters. Free cash flow 255. So we have surplus of 71 million US dollars. Dividends are covered, and we have cash of 750 million US dollars. This is about 3 to 4 times more than, or 3 to 4 times years of dividend payments. So, and we have a relatively stable and solid business model. Exception, lockdowns are not good for the business model, and this is why we had a dividend cut here. But if we have no further lockdown, I think the business is stable, cash flow is stable. So, in my point of view, dividends are more safe for the Wendy's company than Pfizer's dividends are. Okay, let's check the multiples. Here you can see that multiples of 17, and we see that contrary to Pfizer, we have much lower multiples than in the historic average. We can make comparison with McDonald's, for example, same business. And then we see here, okay, Wendy's in brown, long time, had higher multiples than McDonald's. And just it was until Corona came and at the same multiples. And right now, Wendy's got cheaper, trade with lower multiples than McDonald's. And we can also look at restaurant brands, and then we see here of the same picture. Okay, restaurants brand partly was lower valued, was from all three, at lowest multiples, but right now lowest multiples has the Wendy's company. And what's also interesting, I took a look at the same store sales of all three companies is a very important metric, is a key performance indicator, telling you about the sales of the existing stores, so without new openings and closings, so this dilution. And same store sales of Wendy's last quarter was up 2.8%, and McDonald's compared to this 8.8%, and restaurant group Burger King 7%. So you see right now the Wendy's company is not running so fine compared to their competitors, which also means that when we do the fair value calculation, we need to lower the multiples a little bit to take this into account. And we use the adjusted earnings once more for the valuation. And this is it. And then we see here, let's zoom in a little bit, that the stock right now seems to be undervalued. We have the lackluster performance of the stock here for some years already. We skip these estimates because they are completely unreliable. There was only one analyst and now 3 analysts. Here it's 17, up to here, up to end of 25, it's okay to take that. And if we use it out of the box, we have a fair value of $34 compared to a stock price of below 20. This would result in an annual expected yield of close to 40% for the next 2 years, which is much too high, I think, because the adjusted price earnings of 19 is okay. It's the real fact. But here we have the average of 28, and this average is much too high. And I lower it to where the market sees the company around. I lower it to 20. And now you get a much lower fair value. Now the fair value is Now the fair value is $24.60, and the stock price was already as high as $24.70. So it's close to all-time high, but the stock has 2 years. We give the stock 2 years time to recover to its all-time high. And then we have an expected annual yield still of 80.5%. In my point of view, this is attractive. So the stock is more attractive than Pfizer. Okay, let's go to the stock number 3, and the stock number 3 is Conagra Brands. And Conagra Brands, I even made a video recently about them, but I think they are still attractive because we have a dividend of more than 4%, which is higher than in the past. Here we have the performance. Performance is around the same within the last 10 years as Pfizer. If you look, if dividends are safe, we have the earnings, adjusted earnings, free cash flow, and they all cover dividends nicely. And we also see here, because dividends are nicely covered, we have a stable business model. It's not so important about the liquidity, about the balance sheet, if the running business, if dividends are financed by the ongoing business. And luckily, because we have only liquidity of 60 million compared to dividends of 640 million. So Conagra Brands dividend relies on enough free cash flow and enough cash flow to be sustainable. But I think this is the case here. We can make a little question mark, but I don't see right now what should happen for the dividends to be cut. Hopefully I am right. If you see something different, then you can tell me. Here we have the earnings presentation from Conagra Brands. They were hit hard by declining volume, but now we see that Conagra Brands nicely recovers. Volume is still a little in decline, but much less than before. Many people probably already emptied their refrigerator. You know what I mean? And now they must buy new frozen food. Okay, let's go to the valuation. Multiples are here. You see that the stock trades on much lower multiples than in the past, with current multiple of around 11. And let's check the fair value. Fair value, adjusted earnings once again. And then we have here expected yield of 40% for the next 1 to 3 years. The business year ends in May, so 3.5 years even. So this might be attractive, I think. What we can do is lower a little bit the valuation if we take longer. Let's see. Here you see that the adjusted earnings go up and down, a little zigzag, but in general they go up. And what we can do is we enlarge the valuation calculation for a longer period, then it goes down from 37 to 30. If you make it even longer, then you get even lower multiples. And this makes the valuation a little bit even more conservative. And if we look what annual yield to expect right now, it's still 12%. Now, I think that's okay, solid business model, and at least also more attractive in my point of view than Pfizer, with a better risk-reward ratio. Okay, you can now tell me which of these three stocks is your favorite dividend stock on discount. I'm happy to read your comments, we're happy to discuss, and maybe you also have proposition about which stock to analyze next. See you soon in the next video. Thanks for watching. Bye bye.